Okay, let's unpack this. Today, we're taking a deep dive into the latest financial results from Aditya Birla Capital Ltd. This is for Q1 FY26, so the quarter ending June 30th, 2025. Our mission, as always, is to pull out the most important nuggets of knowledge and insight from their press releases, the earnings call transcripts, and of course, the financial statements. If you've ever wondered how a massive financial conglomerate like this not only grows, but also smartly adapts in, well, a pretty dynamic economy, you're definitely in for some really insightful stuff today. Maybe even some surprising findings. We'll explore their overall performance, zoom in on the key business segments, and try to uncover the strategies that are really driving their success.
We absolutely will. And, we're looking beyond just the raw numbers here. We want to understand the why behind the trends, connecting the dots on how ABCL is using digital transformation and actually some pretty shrewd risk management to navigate the current landscape. It really highlights some crucial dynamics playing out in the broader financial services sector and what it all means for customers and the market.
That's it, exactly.
Yeah.
So, what does this all mean for you? Whether you're just curious about the Indian financial market or maybe looking for some quick, actionable intelligence, we're going to break down how they achieve that robust double-digit revenue and profit growth. We'll look at how their lending and asset management portfolios are soaring, and crucially, how their strategic digital platforms are pulling in millions of new customers and really transforming their operational efficiency. So, let's start with that big picture. How did Aditya Birla Capital navigate things this quarter?
It really shows a company not just growing, but strategically positioning itself, wouldn't you say? They announced these Q1 FY26 results back on August 4th, 2025, and the headlines look strong. Consolidated revenue for the quarter up a solid 10% year-on-year to 11,333 crore. Solid indeed. And their operating profit followed suit, up 13% to 1,406 crore. Profit after tax, the PET, also saw a healthy 10% increase. That's 835 crore. But the real story, I think, is in their core businesses.
Their overall lending portfolio, so that's the NBFC and housing finance combined, it expanded significantly, up 30% year on year, hit a massive 1,065,832 crore.
Wow, 30% is significant growth.
It really is. And their total assets under management, AUM, across asset management, life insurance, health insurance, that grew an impressive 20% year on year to over 5,053,504 crore. Huge numbers.
Absolutely huge.
Now, a massive driver for ABCL, it seems, has been their strategic focus on this robust omnichannel approach, reaching customers wherever they are, digital or physical.
Makes sense.
Their direct-to-consumer platform, they call it ABCD. It seems like more than just a customer service tool. They're calling it a full-blown acquisition engine. Offers over 25 products, payments, loans, insurance, investments. And it's already brought in about 6.4 million customer acquisitions.
That's quite the engine.
Yeah. And then there's Udyog Plus. That's their B2B platform for MSMEs, those small and medium enterprises. This offers seamless, paperless digital journeys for business loans, supply chain financing. It's scaled up significantly over 2.4 million registrations, an AUM of 3,658 crore. And get this. It contributes about 30% of their unsecured business loans, AUM, and 37% of disbursements from the wider Aditya Birla Group ecosystem.
So really integrating with the parent group, too. That's smart synergy.
Exactly. But it's not all digital. They're also expanding their physical footprint. Added 67 new branches this quarter, totals now 1,690 across India, and this physical expansion is specifically targeting deeper penetration into smaller Tier 3 and Tier 4 towns, opening up completely new customer segments for them.
And if we connect ABCL's performance to the broader Indian economic context, it really paints a clear picture. The management themselves described the environment as having, quote, trends, stability, and opportunity, even with global uncertainties. We've seen softer CPI inflation, encouraging monsoon progress. That influences the positive outlook.
Right, setting the stage.
Exactly. Plus, the Reserve Bank of India's actions, the recent repo rate cut, various liquidity measures, they're clearly aimed at stimulating growth. So this provides the ideal backdrop for how ABCL's strategic choices, like their digital push and this omni-channel approach, they aren't just opportunistic. They seem well aligned with those national economic goals, fostering financial inclusion and growth.
Okay, so building on that strong foundation, let's zoom into the specific business verticals. Let's start with the NBFC business, non-banking financial company. This segment saw its AUM grow 22% year on year and 4% sequentially. That's 1,031,257 crore. Disbursements also up 18% year on year, reaching 15,851 crore. Their profit before tax, PBT, grew 11% year on year to 925 crore. And return on assets, ROA, stayed stable at 2.25%. Now, those growth numbers are definitely impressive, but rapid growth, especially in lending, it often comes with increased risk, doesn't it?
It certainly can. That's a critical question.
So how is ABCL managing their asset quality amid this expansion? Are there any specific strategies that stand out to you?
Yeah. Well, that's where ABCL seems to really demonstrate a disciplined approach. Because despite that rapid growth, they've actually improved their loan quality metrics. What's fascinating here is their gross stage 2 and 3 ratio for the NBFC business, which, basically flags loans showing early stress or those already non-performing. That ratio improved significantly by 75 basis points year on year. That's 0.75%, down to 3.7%.
That is a significant improvement alongside growth.
It is, and it's a testament, they say, to their prudent risk management practices. For instance, they've taken proactive steps in unsecured loan segments, personal, consumer, small-ticket MSME loans. They've tightened underwriting standards, calibrated how they source new loans.
So being selective even while growing.
Exactly. While personal and consumer loan disbursements grew, remarkably, 65% year on year, which indicates maybe a more stable environment there. They're maintaining a cautious approach, as they put it, in that small-ticket unsecured MSME segment. There are still uncertainties. Disbursements in that specific area actually declined 8% sequentially. But it's important context. This segment is small, less than 1.5% of the total NBFC portfolio, around 8,100 crore.
Okay, so managing exposure there.
Right. And what's particularly insightful is that about 53% of the Stage 3 unsecured business loans in this segment. They're covered by central government guarantee schemes. These protect 75% of the principal. Refunds typically take maybe 12 to 18 months. So it really highlights how they're strategically mitigating potential risks, even in tricky segments.
Okay, good context. Now, shifting gears to housing finance. This segment saw, well, truly exceptional acceleration. Disbursements skyrocketed, a phenomenal 76% year-on-year jump to 5,404 crore.
76%.
Yeah. While their AUM grew 70% year-on-year to 34,605 crore, profit before tax surged an incredible 82% year-on-year to 154 crore. Their return on assets also saw an uplift, and return on equity jumped 132 basis points to 12.27%. Pretty strong.
Very strong metrics.
They've also significantly improved asset quality here, too. Gross stage 2 and 3 ratio improved by 129 basis points year-on-year, down to 1.34%. And looking ahead, they're ambitiously targeting an ROA of 2.0 to 2.2% in the next 6 to 8 quarters. Shows real forward momentum. They've also managed to absorb those repo rate cuts by passing on 15 basis points to customers, while keeping a strong, diversified portfolio mix, prime affordable, even a resilient loan against property or LAP segment.
That housing finance performance is really something.
Yeah.
It really stands out. Now, the asset management business also crossed a big milestone this quarter. Their mutual fund quarterly average AUM, the QAAUM, grew 14% year-on-year. It's over 4,003,479 crore now. Monthly SIP flows, systematic investment plans hit above 840 crore. And these consistent retail investments make up about 40% of their total AUM. That indicates pretty strong investor stickiness, right?
Yeah. SIPs show retail commitment. It's a good sign.
Operating profit for this segment increased 21% year-on-year to 254 crore.
But what's the deeper story behind these numbers? What about the growth in their alternate AUM, that 8x rise in PMS-AIF you mentioned? What does that tell us about their strategy and maybe the market itself?
Well, what's particularly noteworthy here is ABCL's successful diversification beyond just traditional mutual funds. That massive growth in their alternate AUM, including real estate, which grew 2.64 times year-on-year to nearly 40,000 crore. And that truly impressive 8x rise in their portfolio management services and alternative investment funds, PMS-AIF. It signals a clear strategic pivot. This isn't just about adding new products on the shelf. It's about attracting a new tier of, let's say, sophisticated investors and tapping into higher margin businesses. It shows they're agile, responding to evolving investor demand, and building a more resilient, diversified revenue stream for the long run. Plus, the fact that 80–85% of their AUM is in the top 2 quartiles for 6-month returns, that just reinforces that their fund performance is solid, supporting this strategic shift.
Good point. Okay, next up, life insurance. This business outperformed the private sector quite significantly. Their individual first-year premium, FYP, grew a robust 23% year-on-year. That's way higher than the private sector's average growth of just 8%.
Big difference there.
Yeah, so this strong performance meant their market share in individual FYP increased by 60 basis points year-on-year, up to 5.1%. Renewal premium also grew a solid 18% year-on-year, and get this, 81% of those collections came through digital channels.
Shows that digital adoption is really embedded now.
definitely. Their net value of new business, VNB margin, increased by 109 basis points to 7.5%, so improved profitability from new policies.
Yeah.
And their 13th month persistency is at 87%, still top quartile. Means they're keeping policyholders, doing a good job there.
And if we connect this to the bigger picture, a key strategic nuance here is their deliberate slowdown in the group traditional fund business. This was due to reducing interest rates. Now, this isn't a sign of weakness.
Right.
It looks like proactive management, prioritizing portfolio quality and margins over just sheer volume in a changing rate environment.
Right.
And this decision actually highlights a broader question for financial firms, doesn't it? How do you strategically balance market share growth with protecting profitability in dynamic markets?
That's a constant balancing act.
It is. But despite this calibration, the company still aims for a 20 to 25% compound annual growth rate in individual FYP and to double their net VNB over the next 3 years. That speaks volumes about their confidence and long-term vision for the individual segment.
Okay, finally, let's look at the health insurance segment. They're embracing this health-first model. Gross written premium, GWP, grew 30% year-on-year to 1,357 crore. And if you exclude the impact of some multi-year guidelines, that growth jumps even higher, 40% year-on-year.
That's substantial growth.
It is. Their market share among standalone health insurers, SAHIs, increased by 200 basis points year-on-year to 14.5%. So strong market share gains. Their combined ratio also improved slightly to 111% from 112% last year. That indicates better operational efficiency, claims management. But that health-first model sounds intriguing. Can you tell us more about how it actually works? What impact is it having?
Yeah, this is where their approach gets really innovative, I think. Their differentiated health-first model, it isn't just a catchy phrase. It's a strategy focused on incentivizing wellness, moving beyond just paying claims. And the numbers really back this up. 9.1% of eligible customers actually own good health-based incentives.
Okay, so people are engaging with it.
They are. And crucially, these engaged customers showed a 4% lower loss ratio, meaning fewer claims and 10% better persistency. They're staying with the insurer longer. So this model gives them a clear selection advantage, right? Attracting more health-conscious customers. And it gives ABCL a deeper understanding of health profiles. It's fundamentally trying to transform how health insurance works for both sides, shifting focus towards proactive wellness and prevention.
That's a really interesting angle.
It is. And beyond this model, their corporate business also saw strong growth, up 41%, maintaining a profitable group business. And they've even onboarded Bank of India as a new bank assurance partner, which significantly expands their reach.
Okay, so quite a bit happening across all segments. What about their overall financial health and the forward outlook?
Well, looking at their financial health, ABCL seems to be on very solid ground. Their overall capital adequacy ratio, CR, the key measure of financial strength, is a healthy 18.1%. Tier 1 capital is at 15.62%. Strong buffers. During the quarter, ABCL also strategically put 250 crore into their housing finance subsidiary.
Right, you mentioned supporting that growth.
Exactly, supporting that strong momentum we talked about. And management indicated they're sufficiently funded for growth needs for the next 9 to 12 months. That provides clear stability. Furthermore, the security cover for their outstanding non-convertible debt stands at a robust 1.34 times, shows strong backing for their debt. Oh, and it's worth briefly mentioning the amalgamation. Aditya Birla Finance Ltd. Merged with ABCL effective April 1st, 2024. This just simplifies the corporate structure. ABCL now operates as an NBFC ICC, an investment and credit company. Basically streamlines their core lending operations and directly contributes to these consolidated results we've been discussing.
Got it. Streamlining helps. And beyond just capital, they're also focused on operational efficiency, right?
Absolutely.
The OPEX to AUM ratio for their NBFC business improved by 18 basis points just sequentially. That's largely driven by operating leverage as those newer branches mature and become more productive.
Economies of scale kicking in.
Yeah. And similarly, housing finance also saw an OPEX to AUM improvement by 32 basis points sequentially. It indicates the payoff from those past strategic investments they made in distribution, data, digital infrastructure. These are the kinds of details that show smart, long-term planning is actually paying off now.
That's right. It's not just top-line growth. They're managing the bottom line, too.
And as for management priorities moving forward, it seems clear they're continuing to emphasize, quote, driving quality and profitable growth, leveraging data, digital, technology, alongside strengthening that omni-channel distribution network we discussed. The overarching emphasis seems to be on customer centricity. providing, as they say, simple and holistic financial solutions in a seamless way. It's a clear, consistent vision for, well, thoughtful, continued expansion.
Seems like a well-rounded strategy.
So, wrapping things up, what's your biggest takeaway from this deep dive into Aditya Birla Capital's Q1 FY26? For me, it's that impressive combination of, well, really rapid growth across multiple segments, especially housing finance and individual life insurance, but coupled with a really thoughtful approach to managing risk and leveraging those digital platforms. It feels like it's not just about getting bigger, it's truly about growing smarter with a clear strategy. What about you?
Yeah, I agree with that. My biggest takeaway is maybe how ABCO isn't just, riding the Indian economic growth wave, but is actively trying to shape it through those targeted digital platforms like ABCD and Ujog Plus, and by innovating within its product lines like that health first model we talked about. And this, I think, raises an important question for you, the listener, to consider. As digital adoption just keeps accelerating and financial needs continue to evolve, how might these integrated tech-enabled financial ecosystems redefine what a bank or an insurer even looks like in the future? It's definitely something to mull over as you think about the evolving financial landscape ahead.